Hello, this is Sunko, the Korean bro. Today is 2024, um, January 14. Time flies indeed. It's already 2024. The first time when I started YouTube was 2 years ago, and now 2 years has passed. Okay, let's start reading articles tonight. Okay, buying the new Bitcoin ETFs, three things to keep in mind. Apple stock, time to buy the D. Let's see. Though the stock has pulled back some, shares still aren't cheap. Strong growth in Apple services is a promising development for the business's long-term growth potential. The iPhone maker's robust balance sheet and nearly $100 billion in annual free cash flow shouldn't be underestimated. Robust balance sheet and nearly $100 billion in annual free cash flow should be underestimated. The tech giant shares have stumbled out of the gate this year. Is this a buying opportunity? Following a great 2023 for Apple shares, which soared 48% higher, the stock is taking a breather so far in 2024. Year to date, shares are down more than 3%. Is this an opportunity to buy shares of the iPhone maker, or is the stock's decline justified? To explore whether or not shares are attractive today, let's look at both the bear and bull cases for the tech stock. Bear case. The bear case for Apple can be summarized in 2 points. The tech company has struggled to grow revenue recently and stock's valuation has become borderline frothy. This has some investors worried that the company may not meet the high expectations currently baked into the stock price. Regarding the Cupertino-based company's growth, fiscal 2023 revenue fell nearly 3% year over year. Um, Further, earnings per share barely budged, coming in at $6.13 for the period, up from a $6.11 year ago quarter. A pullback in iPhone sales and a dramatic decline in Mac sales weighed on the year's results. Foreign exchange headwinds were also a major factor pulling down revenue and earnings. Also raising some eyebrows is the stock's valuation. Over the last year, the stock's price-earnings ratio has gone from a 22 to more than 30. Viewed another way, the company has a $2.9 trillion market capitalization, despite annual earnings only coming in at $97 billion. So this high valuation bakes in robust earnings per share growth for years come. More specifically, a valuation this level demands average annual earnings per share growth in the mid to high single digits over the next decade, and more importantly, continued market dominance in lucrative segments like its iPhone and services business. The bull case, but don't count Apple out. The bull case highlights several reasons the company could deliver strong earnings growth in the coming years. First, there's Apple fast growing services segment. The segment, which includes the revenue from services like Apple Pay, Apple Music, Apple Care, and revenue share from a third-party application in the App Store, grew 16% year over year in Apple's most recent fiscal quarter. So further management said that the company expects similar um, growth when adjusted to exclude revenue from the extra weight in the year ago period, the first quarter of fiscal 2024. So longer term, there's a good reason to expect Apple's momentum in services to persist. The tailwinds for the segment are numerous, including a nascent but meaningful advertising business, Apple's ability to bring new services to market over time, and rapid growth in third-party app subscriptions. So another reason to be bullish in Apple stock is its strong balance sheet combined with management's excellent track record of good capital allocation. So the company ended fiscal quarter four with a net cash and marketable securities position of $51 billion, with a goal to become cash neutral. Over time, Apple has been steadily repurchasing its share and paying dividends. Further, Apple has a history of opportunistically buying back more stock when shares appear cheaper. This prudent approach to repurchases make every dollar go further than if the company purchased the same amount of shares every quarter, no matter where the stock traded. Of course, with annual free cash flow of nearly $100 billion, it's going to take some time for Apple to become net cash neutral. So investors can expect the company to repurchase shares in substantial sums and pay meaningful dividends for the foreseeable future. Combining these positive developments with the company's loyal customer base and Apple's long history of innovation, the tech stock arguably deserves to trade at a premium valuation. While it may not make sense to be an aggressive buyer of Apple stock at this valuation, it may make sense for investors without exposure to see stock to a short a small position following its recent deep. The Switch is nearly 7 years old and due for a big upgrade. The next Switch could revive Nvidia's Tegra business. Okay, the market often overlooks Nvidia's close relationship with Nintendo. So, stock quadrupled over the past years as rapid expansion of the artificial intelligence market lit a fire under its data center business. Its high-end GPUs are used to process complex AI tasks, and most of the world's leading AI companies, including ChatGPT's creator OpenAI, currently use its chips. But as the AI hype winds down, many investors are likely wondering if Nvidia can maintain its momentum. The AI market should continue to expand, but investors shouldn't ignore another potential catalyst for Nvidia stock in 2024, Nintendo's rumored launch of its next Switch console. So Nintendo has sold 132.5 million Switch consoles since its launch in 2017, making it the best-selling gaming console in the world. By comparison, Sony has sold an estimated 170.2 million PS4s since 2013 and 15.8 million PS5 since 2020, while Microsoft has sold 58 million Xbox One share since 2013 and 25.4 million Xbox Series S and X consoles since 2020. So Nintendo Switch is less powerful than Sony and Microsoft's consoles, but it gained a loyal following with its hybrid form factor. It can be used both as a handheld and a dock system. Its large library of exclusive first-party games. The Nintendo Switch runs on NVIDIA's Tiger X1 system on a chip, which the chipmaker previously installed in its own show tablet and Android TV devices. The ARM-based Tegra isn't a graphical powerhouse like custom advanced micro devices APUs that power Sony and Microsoft's latest consoles, but it gives the Switch the mobility and power efficiency of a high-end smartphone or gaming tablet. NVIDIA reported its Tegra chip sales separately until fiscal 2020. So during that year, it generated $1.45 billion in revenue, or 13% of its top line, from its Tegra chips, but that represented a 6% drop from fiscal 2019, mainly attributed that decline to its slower sales of gaming SoCs, which partly offsets rising sales of automotive chips. So Nintendo Switch sales declined for three reasons. First, it faced tough comparisons to the pandemic 2020, which brought new players to the console with hit games like Animal Crossing and New Horizons. Second, the Switch had largely saturated its core market and was drawing its age. That's why its OLED upgrade in 2021 disappointed a lot of gamers and investors who had expected a brand new console. Lastly, the persistent chain supply constraint exacerbated all that pressure. So, however, a series of recent rumors suggest Nintendo will finally launch its long-awaited Switch 2 this year. Most of these reports claim the console will be powered by a next-gen NVIDIA Tegra SoC, which adds support for 4K gaming, along with the DLSS features that are currently exclusive to its top-tier RTS gaming GPUs for PCs. The next Tegra chip costs roughly the same, and Nintendo sells under 130 million Switch 2 consoles. It could potentially translate to $3 billion to $4 billion in long-term sales for Nvidia. That's all speculation for now, but it's still a meaningful figure for a chipmaker expected to generate $58.9 billion in sales this fiscal year. The Tegra certainly won't generate as much revenue as its data center or gaming GPUs, I believe the launcher they switched to might just give the bulls a fresh reason for to buy Nvidia's high-flying stock this year. Alphabet here, Marco Libre, Vertex Pharmaceuticals. Royalty income. Okay, here we have Amazon. You could think of Amazon as the ultimate growth stock. The company dominates in two areas that are growing in double digit e-commerce and cloud computing, and also is on track to win in the hot area of artificial intelligence. So AI is helping Amazon's e-commerce business to become more efficient, reducing cost and favoring profit growth. Um, So, in Amazon Web Services, new AI tools should lift the demand for its cloud services. This is a key because AWS has generally driven Amazon's overall profit. Uh, and speaking of profit, Amazon has demonstrated its ability to grow earnings over time, mm, as well as its ability to quickly recover after tough times. So after a weight economy drove Amazon to an annual loss in 2022, it improved its cost structure and reported quarterly profit gains last year. Today, Amazon shares look very reasonably priced compared to their past valuation in relation to forward earnings estimate, especially considering growth prospects ahead. So NVIDIA, Amazon. Okay, NVIDIA is market leader in data center accelerators and AI processors, and management sees substantial upside in AI networking and software. So Amazon is a market leader in cloud computing and AI developer services, but it also has a big opportunities in online retail and digital advertising. Okay, here we have it. Here, okay. Nvidia has three primary growth engines: gaming, professional visualization, and data center businesses. So, though the automotive segment could become a substantial source of revenue as the robotaxi market blossoms, NVIDIA has deep roots in gaming and professional visualization. Its invention of the GPU in 1999 revolutionized computer graphics, and the company still holds more than 90% market share in workstation graphics processors. NVIDIA also added monetization opportunities by branching into software with Omniverse, a suite of applications that support 3D design and virtual simulation. The latter is useful in training machine learning models for autonomous robots and self-driving cars. So, guided by visionary CEO Jensen Huang, NVIDIA moved into data centers in 2006 when it introduced the CUDA programming model, turning its GPUs into general-purpose processors. The innovation laid the foundation for tremendous success. Today, NVIDIA dominates the market for data center accelerators and machine learning chips. In fact, Forrest Research has said NVIDIA GPUs are synonymous with AI infrastructure. In a recent note to clients, Rosenblatt analyst Hans Musima highlighted adjacent AI monetization opportunities in data center networking and software. To elaborate, network sales has tripled over the past year to become $10 billion business. The CEO Jensen Huang says it will get much larger. Similar to CFO Colette Chris says NVIDIA started to see excellent adoption of AI software during the most recent quarter, an encouraging update given the management sees it as a $150 billion market opportunity. Here's the bottom line here. GPU sales are projected to increase by 28% annually through 2030, while the AI market is projected to expand by 37% annually during the same period. So that gives Nvidia a good shot at 25% annual sales growth through the end of the decade, despite that its present valuation of 29 times sales looks a little pricey, especially when the 3-year average is 23.5 times sales. Investors comfortable with volatility can buy small position today, provided they're willing to hold the stock for at least 5 years. The triple-digit return baked into a Rosenberg's 12-month price target is unlikely, given the elevated valuation, but it is possible over a 5-year time period. So Amazon has three main growth engines: e-commerce, digital advertising, and cloud computing. And the first two opportunities are interconnected. Specifically, Amazon operates the most visited online marketplace on the planet. The eMarketer says the platform accounted for 38.7% of retail e-commerce sales across North America and Western Europe last year. The scale means Amazon is uniquely positioned to engage shoppers and source data from its marketplace, and the company has leveraged the advantage to build this booming advertising business. In fact, Amazon recently became the third largest ad tech company in the world. Its recent decision to bring ads to Prime Video as the other opportunity. Not surprisingly, Bush security analyst Scott David is particularly bullish on Amazon's ad tech business, uh, and he recently wrote, "The company is well positioned to continue taking share of global digital uh, advertising spending over a multi-year period." But David is also optimistic about the cloud computing business, Amazon Web Services, where he believes growth will accelerate in 2024. So whether that happens or not, AWS is indeed primed for long-term growth as the AI boom unfolds. Consultancy Gartner has recognized a leadership in cloud AI developer services, and AWS recently expanded its portfolio with the launch of a Bedrock and Amazon Q. The former is a development platform for generative AI applications. The latter is a generative AI business systems. Both could help AWS tap the growing demand for generative AI software. A market Bloomberg believes will grow at 69% annually through 2032. So here's the bottom line: retail e-commerce sales. So retail e-commerce sales are projected to increase at 8% annually through 2030, while the ad tech and cloud computing markets are forecast to grow at 14% annually during the same period. Amazon will likely split the difference, meaning annual sales growth could range from 10% to 12% through the end of the decade. That aspect leaves room for upside should Amazon be especially successful in its AI ambitions. In either case, its current valuation of 2.8 times sales looks quite reasonable, especially when the 3-year average is 30 times sales. Patient investors should consider buying a small position today, but the key word is patient. 41% upside baked in Wedbush's 12-month price target seems a bit too optimistic. So, but Amazon could certainly beat the market over the next 5 years. Alphabet here, okay. Says and also will soar into my top 10 growth. The market rebounded from historic lows last year. History suggests there's more where they came from. Bull markets have historically lasted 4 years, generating triple-digit gains in the process. Each of these stocks is well positioned to lead the bull market higher. Alphabet, a significant decline in digital advertising in 2022 and a pause in the growth of cloud computing spending hit Alphabet hard. A significant decline in digital advertising in 2022 and pause in the growth of cloud spending hit Alphabet hard. But the improving economy is sparking a rebound. Google remains the global search leader, the world's largest online advertiser, and a big three cloud infrastructure provider, which will continue to buoy its fortunes. Perhaps the biggest catalyst will be Alphabet's efforts involving artificial intelligence. Alphabet recently rolled out Gemini, a program it claims is the most advanced generated AI system yet. It also offers more than 100 pre-built AI models via Google Cloud and custom tools to make users more productive. This gives Alphabet multiple catalysts to boost its stock in 2024. Trading at 4 times forward sales, the stock is historically cheap. Okay, Amazon here. Economic headwind led by soaring inflation weighed heavily in Amazon in 2022. But green shoots of growth are appearing across vast operations. This retail is bouncing back, and AI is boosting cloud spending, fueling its two largest growth areas. The company has also planted its stake in AI, providing cloud customers with all the top generated AI models via Amazon Web Services. The company continues to integrate AI into every aspect of its operations. Improving productivity along the way. The twin tailwinds of an improving economy and AI will drive Alphabet higher. Um, Trading just 2 times forward sales, the stock is still. Processors have long been the gold standard for gaming, data center, and artificial intelligence use cases, capitalizing on the generative AI boom that hit last year. The resulting shortage of AI chips is expected to persist through 2024. NVIDIA ramped up production to meet the accelerating demand and continues pouring money into research and development, creating ever-improving solutions. The company has generated triple-digit year-over-year revenue and profit growth in each of the past 2 quarters. The soaring demand for AI is expected to continue. NVIDIA's price-earnings growth ratio of last one is cheaper than the broader market, making this stock still. Despite a punchy couple of years, Roku remains the world's most widely used streaming platform. With 51% of the market, the dearth of ad spending last year has begun to lift, and with multiple viewers across 76 million active accounts, this compelling opportunity advertisers can't ignore, fueling ad growth in its platform. Furthermore, the secular tailwinds of cord cutting and the deterioration of broadcast viewing have caused an ongoing advertising shift from a broadcast to streaming. Roku is the one place to reach these highly engaged viewers who consume 26.7 billion hours, or roughly 3.9 hours per day, and roughly 3 times forward sales, investors getting a bargain. With the downturn largely in the rearview mirror, things are looking up for Shopify, become expanding its return to growth. As a leader provider of software tools for online merchants, Shopify is positioned to thrive. The company released new generative AI tools to help sellers prosper and has a minority stake in global e-online, which helps the merchants expand into international markets. Shopify streamlined its operation last year, streaming staff and shedding its logistics business to focus on its mission to empower digital retailers. This has fueled strong growth and profitability, making Shopify a compelling opportunity for investors. Tesla has a reputation as a battleground stock, but it continues to defy detractor. Last year, the Model Y became the world's best-selling car by a comfortable margin. A fast-fuel electric vehicle, despite headwinds and price adjustment, which led to temporary profit declines, the company continued to drive further into the automotive mainstream. With inflation cooled and interest rate expected to drop next year, conditions will be much more favorable for Tesla. This could help the company return to its long-term production goal of 50% annual growth, while also helping expand its profit margins. Finally, 5 times forward sales is a pretty reasonable valuation, especially considering the stock price gains of more than 2,300% over the past decade. I'm read the article related to Tesla, and then I'll put an end to today's YouTube live. Okay. Recently, we had big um, Tesla Tesla news. Mm. Okay, Tesla and BYD are the world's largest electric vehicle makers, becoming more direct competitors in China and much of the world. A lot of attention is focused on EV startups such as NIO, Li Auto, Aspen, Rivian, and Lucid. Efforts by traditional auto giants such as General Motors, Ford Motor, Volkswagen also gets coverage. However, Tesla and BYD stand apart. Oh, in 2022, China EV and battery giant BYD's vehicle sales raced ahead of Tesla's. For all battery electric vehicles, BYD seized the crown in Q4 2023. BYD also has significantly higher gross margin than Tesla and has massively closed the gap in net income and revenue. In Q3, Tesla reported its worst earnings in 2 years, easily missing lower analyst views. BYD delivered strong third-quarter earnings and sales growth. Overseas sales are a key area of growth margins for BYD, which recently announced plans for its first passenger EV plane in Europe. So Tesla delivered 484,507 EVs in Q4, beating analyst views of according to consensus compiled by Tesla. Full-year deliveries hit 1.81 million, just topping the company's 1.8 million target, credit strong China sales. Tesla upended the vehicle market when it introduced its first electric vehicle. Growing fast is a different game. Consider the negatives. Here's the interesting the fact that U.S. investors may not fully appreciate. China's BYD produced and sold nearly 9% more electric vehicles in China than Tesla in the third quarter. If you add in hybrid vehicles, BYD's lead is even larger. To be fair, the two companies don't make for an apples comparison. Tesla tends to operate more at the high end of the auto space, while BYD sells cars across price points from a cheap to expensive. Tesla's focus on more costly models help it to support margins. Mm. So while BYD is a lower price inherently hindered its margins, but afforded a larger addressable customer space. But the key takeaway is that in the world's second largest economy, Tesla is not number one in the EV market. China is one of the Tesla's focus markets, given the sheer size of the country economy. In the competitive landscape, there's some investors who will want to consider it when thinking about Tesla's growth prospects. If you're looking at Tesla, you really need to think about BYD, even BYD doesn't sell currently cars in the US because of tariffs. Uh, but that last fact sets up what could be even a large risk for Tesla. What happens if BYD starts to compete on Tesla's home turf? It is easy to dismiss that possibility because of current geopolitical tensions, but you should ignore the risk. For example, if BYD has been a big investment for Warren Buffett, Berkshire Hathaway, even after selling millions of dollars worth of shares, York Amount still owns a roughly 8% stake in BYD. The level of support from the famous investor could go a long way to help BYD find its way into the US market, whether via imports, or perhaps even with a US based manufacturing system. That's pure speculation, but with so many companies starting to open new factories in the US, isn't an unrealistic idea. So the ultimate hidden risk for Tesla is that it has faced a position rival abroad and could someday have to deal with the same company in stronghold US market. At this point, it seems Tesla has continued slugging it out in China, but is facing an only slowly growing attack from rivals in the United States. If things change for the worse in either market, Wall Street could quickly alter its view of Tesla as well. Given the swift price advance in the stock over the past year, long-term investors might want to consider some outlier events when they stress test Tesla investment thesis. Though Tesla does have a competition, it's just that a lot of investors living in the United States don't really don't really don't really get it. But BYD actually sells more electric vehicles than Tesla in China. But once if BYD sells cars, or starts selling cars in the United States, nobody knows what could happen. And even Warren Buffett invest some of his money to BYD, and because of tariffs, um, BYD cars are not being sold in the United States. But once once Tesla starts competing against BYD for real, then nobody knows what could happen. Investment wise, it's something that investors should care about. Anyway, this is it for today, and I'll see you tomorrow. Okay, bye bye, and have a good night.